such nice camera resolution you have.
It takes a lot to make this look good, buddy.
What are you using? You using like a
Canon R6, Eric and RC are telling me in my ear.
couple Canons?
You should see the setup on the other side. There's a lot going on in the background. You guys ready to roll?
Let's go.
Okay, what is up, RE Source? Last week we had a show that we talked about home affordability, and it kind of got real for a minute, and we talked about how mortgage payments jumped about 92% in the last 2 years. We highlighted a Black Knight study where they talked about it's been the least affordable since 1984. That all caused or is causing millennials 1 out of 5 to go, maybe I can't afford a home. Maybe I shouldn't be a homeowner. And so it's kind of an interesting conversation. We also talked about the fix, the possible fix. And Black Knight in their study said it would take a 28% decline in home prices or a 4% drop in rates or a 60% increase in median household income. Now, this is why I love the show and I love my relationship with Barry, who is on the show again today. I'm traveling. He calls me and says, "Hey, Hills, watch the show, but I think I have a different opinion." And I love the fact that one, he's such a high level individual and influence. He's actually watching the show every week. I appreciate that. And two, he cares enough to come back and go, "Hey, can we come back on next week and kind of talk about maybe some better solutions? Maybe it's not so hard as what the Black Knight study indicated." So back by popular demand, our good friend, Barry Habib.
Love being with you. Of course, I watch the show. You put out such great content. You got great guests. You do an amazing job, brother. I mean, you're such a blessing to our industry. And yeah, we always have to be careful when we get an article like that. It's probably some young person writing an article, wants to get clickbait on it, and they either don't have experience or intentionally skewing negativity because that's what sells. So we have to dig under the hood. And when we do, we find out that the facts are different than what they're putting out there to try and get clicks.
Well, and I appreciate this, guys. This is a healthy relationship when Barry can call me and go, "Hey, I liked what you did, but maybe you missed this." Like, I didn't get offended. I was like, "Great, let's come back in and talk about it," because what you articulated and what you're about to show was super cool, super positive, and gave me a whole different perspective that I didn't have just staring at that one study. So I appreciate that, man.
Well, right. Look, so first of all, let's iron sharpens iron, right? Just so it's what we do with each other here, right? So, what I think we have to think about is that there is enough anxiety and concern in our community already, and then of course the statistics, people say, oh, 160,000 licensed professionals going down to 90. Now you got to count bank professionals that don't have their NAMB license, but
Right.
MLS.
NMLS, yep.
license.
I
got
know.
too many initials.
We know what you
going
meant.
there. An MLS license. So you add those to it, and it's a significantly higher number, but still the change is relative as well because there's a big drop off. So first of all, you're listening to this, you're in the mortgage industry, congratulations. But I want to give you hope because there's some things that I think are good to look forward to. So let's first address this affordability thing, and I got some slides, bro. So let's talk together as we go through.
Yep.
Because the payments risen, as you said, 90% over the past 2 years. Okay, so no qualms about that. But income's up 16%. Now, here's where we look at statistics. You only use 25% of your income towards housing, and I know the article. Talk about the article said, brother.
Article said 38% of median income, and you had a really good point to come back again about maybe that was just used for shock value. Go ahead, and I wanted you to touch on that to kind of give a better perspective of this challenge here.
Yeah, you don't use median income because that median includes everybody. And what's weighing you down? Well, God bless those 16-year-olds working at McDonald's, but they're not today's home buyers. So you take them out of the equation and you go by the numbers that Fannie Mae says. It's closer to 22%. So I'm being generous and saying 25%. Just use I use 25% so it's easy to see. So 16%, if you're only using 25%, that's a 64% offset on this number. But let's also be fair. Like, I always like to give both sides of the coin here, So while that's an offset, I want to be cautious here. We've had inflation. So I calculated the inflation differential, and income increases amongst those who are truly in the home buying arena, according to what the numbers from Fannie Mae are offsetting about half of that. It's probably a little more than that, but let's just say about half. So 43% is what I come out with the numbers, but I was a little bit cautious here. It's about half. So it still makes it, no question, it's less affordable. It's tougher. I'm not arguing that. I'm just trying to make the numbers right. So it's also something that we want to look at, not just standing still, but let's move forward, right? Let's look through the front windshield.
Right.
Next year's income rise, that's a normal income rise with about a 1% drop in rates, probably does the trick. And remember, there's far more qualified buyers still than inventory available. So, what does this mean? Two things. You're going to cure this affordability problem. I'm going to take you through an actual mathematical example. But even in today's environment, even with this headwind, you're getting 3 bids for every listing and 40% of homes bid over asking price. There is just an overwhelming number of demand versus supply. And that's the other aspect of it, is that I hear it all the time. People say home prices are going to crash, home prices are going to, we don't see that.
Yeah.
A couple of quick statistics. If you want to compare it to 2007, you had 4 million units for sale. Today is a million. But the population was 301 million. Today it's 335 million. So 34 million more people. And they're fighting for 3 million fewer homes. And it's a complete imbalance, much more households formed than those that are being built right now. 2 million household formations, 1.3 million homes being built. That's not going to cut it. Where are these people going to live? It's going to put pressure. So let's do some math. At the end of 2021, you wanted a $400,000 loan at 3 3/4. Here's your P&I payment. Pretty simple. Currently, let's just say since the end of 2021, we have seen 9% appreciation. That's 6% in 2022 and year to date 3% in 2020. So it's 9% appreciation. So we're seeing $436,000 loan would be the equivalent, because you got to go 9% higher, right? I'm not going to take $400,000 loan then. Let's account for that. So it makes it harder with the prices going up. And let's take a rate of 7 1/4. I think the last numbers on average was 7.18. So let's round up. Let's go to 7 1/4. This is literally an $1,124 per month increase. And truly, it is not the 90% that they're talking about, or the 92% they're talking about. As you can see just by doing numbers, 90% difference here, that would be about $3,600 a month. It's $2,900 a month. But who knows what they're looking at? Maybe they're saying taxes went up or something. So I'm going to give it to them. But let's just do the math and say it's $1,124 a month. That's the mathematical difference. But what they failed to do is they failed to look at how it impacts income. Now, in order to qualify for this, based upon the numbers that Fannie tells us, is the averages, you'd have to have a household income about $9,000. Now, we get good data from ADP that said that we have seen an 8% increase up
in the
to
same time frame.
9720 is what the income did. So you've mitigated this to a great extent. But listen, we want to be very fair here, right? You've got to add for inflation of gas, food, and other things. It's going to cost somebody about $400 a month. So you're up $1,524 a month in cost, only $720 a month in income. Well, that's not great. Okay. And by the way, I am giving you like the 2022 number. This does not include 2023's number. Okay.
Gotcha.
So
okay.
That's what it was for 2022.
Could be even better.
Yep. So I am being ultra conservative here. Now, in 2023, what if we go up 6%, which is the pace we're at now, according to ADP? It's actually 6.8. So that's $10,000 a month is what your income went. It started off at $9,000. At the end of 2022 was $9,700. And over the course of the year in 2023, $10,300. So that means your income would have gone up $583. So if you look at where we are, it is still less affordable, but not crazy. Okay.
Not the shock value.
With $1,124, and even adding the $400 for inflation, you're at $221 a month worse. But now, wait a minute. So what's the fix? The fix is income coming up. It's almost there. But what if interest rates drop? I know we said 1%, but how about if it only drops 0.75% to 6.5%? You know that mitigates it completely. You're to break even at 6.5% rates by the end of this year. And I believe that we're going to get there, right? I want to show you what I think is happening with rates. And I know that right now is a tough time, but Ryan, you and I were around and we remember the Implodometer, right?
Oh, for sure.
We have a different set of problems today, but they are nowhere near as bad because this was structural. Forget about a cash out refi. You were doing cash in refis. Yeah, you want the lower rate? You got to put $40,000 more into the home, right? You couldn't buy. Why? Because you couldn't sell because you were upside down. 25% of homes owed more than the value of the home. Do you remember, Ryan, doing appraisals with negative time adjustments? Wasn't that fun? Okay. Yeah. Can't get it to appraise because the appraiser is saying, well, we got to put a negative time adjustment. So we tend to glorify the past. We forget how tough it was. And what I'm telling you today, please listen. the problems that we're facing today are real and they're difficult, but they are not as bad and easier to fix than back in 2010. And what came out of 2010 was a long period of time of great prosperity. If you survived that time, you did
Preach.
freaking great. And by
Yep.
surviving this time, you will too. Let me give you some reasons for hope. So,
The longest amount of prosperity also buried to your point that we had seen in a market run.
Ryan, you're so right. Now, look, there's a lot of business out there. There's 4.8 million real estate transactions, 4.1 existing, and new home sales is 4.8, but only 3.6 million have a mortgage on them. So we got 3.6 million shots here. And refinances, believe it or not, they're being done. They're all cash out debt consolidation. We do some really good stuff on
Yes,
cash out
you
debt
do.
consolidation. Guys, there's like 5 million mortgage transactions. You don't need all 5 million. If you do one transaction a week, that's 50 a year, okay? And you're going to make up like $200,000 if you go by the averages. If you do 2 a month, that's $100,000 in income, which puts you in the top 15% of income earners in the United States. So look, I know it's tough, but just get our share. So how do we do that, right? So we want to be optimistic and we want to understand where the market's going. And a lot of the things that you've heard me talk about and the things that we discuss are all in regards to what to do tactically now. You got to do cash out debt consolidation refinances. You got to do debt consolidation purchases. You have to do bid over ask. You have to do cost of waiting. All of these scenarios will help you do more business down to what your realtors need. But let's take a look at the rates because listen, I got it wrong on saying that beginning May, we'd start to see rates drop and over the summer that they'd be in the fives. Okay. So completely got it wrong. I own that. So what went wrong here? Let's take a look. So we made a very bold forecast on inflation and it was 9%. We say it's coming to 3. Well, guess what? Even though no one believed me and everybody thought I had 3 heads and saying it was going to, we had 3%. So we got it really right on inflation. But what happened to mortgage rates? Well, the bottom line here is inflation of pink. And this line here is blue is mortgage rates. So inflation goes up, mortgage rates go up, inflation goes down, mortgage rates go down. They stay flat, they stay flat. Then you got the distortion from QE, but we come out of QE and inflation goes up, so do mortgage rates. Then inflation comes down, so do mortgage rates. Inflation comes up, so do mortgage rates. Inflation goes down, so do mortgage rates. We got every single one of these right. And we were calling the market like we had, a GPS for it. But then we said, hey, wait a minute. We see inflation coming really way down, especially in May because of shelter costs coming down.
Yep.
And we think inflation is going to hit 3%. And therefore, we say that mortgage rates should be about 2% above that in the fives. Got it wrong. Okay. The inflation part was right, but what went wrong? Why did mortgage rates do this? So there are some extraordinary circumstances that occurred. The banking crisis, which we don't have to go over in detail, but we talked about it, how deposits fleed to go into money markets because the Fed caused short-term rates to go up. People put their money in money markets and banks had to reimburse their depositors and they sold mortgage-backed securities. Then you had the crisis with SVB and you had the crisis with Signature as well as First Republic. And when the FDIC took those over in June and July, they sold their mortgage-backed security assets. That certainly didn't help us. But here's the silver lining is this fleeing of deposits has now eased. Okay. So, you got the fleeing here. You got to sell securities here. When? Well, right when we thought rates were going to come down. Okay. So, and then hold on a second. What happened in June? Gee, thanks. We got a debt ceiling, crisis on the debt ceiling, and we've got to raise it by $270 billion. I never thought we'd have to raise it by $270 billion. That means that you have to sell more treasuries that competes with mortgage bonds. And then I did not see the other thing in July. Hey, thank you, Fitch. You cut our credit rating. Now, you know this, right, Ryan? What happens when the customer's credit score goes down? What happens to the rate? It goes up. Same thing for a country. Our credit score goes down, rate goes up. But the biggest one of all is this guy. Now, this guy's not an economist. He's not a trained economist at all. He's a lawyer. Ryan, God forbid somebody has to go on trial. You don't want an economist representing him in your court, okay?
Right.
And here's the problem with Jerome Powell. Jerome Powell is a human being. He has a very short time frame. He's got a couple of years left, and then he's done. Then he's going to be on the golf course. Okay, so he's done. Now, remember, does he have an allegiance to Biden in an election year? Some people say, what about election year? Well, he's going to be stubborn because this is his legacy now. His legacy is he blew it on letting inflation get out of control. There's no other excuse. He blew it.
Yep.
And now is he going to let inflation get out of control again? He's a human being. He puts his pants on one leg at a time. He does not want to be remembered as the worst Fed chairman of all time. He wants it to still be Arthur Burns for making the same mistakes. He doesn't want to be known throughout history and put that on his tombstone.
Fair.
Now, he does not have any allegiance to Joe Biden. Why? Joe Biden did not want to reappoint him. He wanted it to be Leo Brainerd. Remember that. So he has no political alliance. He just cares about himself, and he's going to be stubborn. So this is what we have to consider. Now, he's told us that he wants inflation to get to around 2% on core PCE and perhaps core CPI. But he has also told us that the jobs data is so strong and the job market's so strong. Ryan, bullshit. The jobs market's not strong. And if you look under the hood, which he can't do because he's not a trained economist, the media can't do because they want clickbait and they're full of crap anyway. And if you start to look under the hood and you see what's going on, you see that the birth-death model has issues. That's businesses born versus businesses closed. It's a terrible way to capture inflection points. Let me give you an example. In July, the seasonal adjustment. In July, we got plus 280 is what it was. Oh, great. Let's go ahead and kill bonds and let's buy stocks because we created all these jobs. You know what the revision was? Down 871. That's $1,150,000 change, but nobody cares. A couple of months later, the benchmark revision down 360. Past 4 months, 228. So, last month, okay, we created 200,000 jobs. That sounds good. Until you see 900,000 were part-time creations, and we lost 700 full-time. These are people that are multiple job holders trying to make ends meet.
Yep.
I'm going out at night to stay afloat.
Yep.
Something nobody looks at, Ryan, is hours worked. Got 160 million people in the labor force. So when you see hours work have been cut by a half an hour across the board, that's the equivalent of 2 million job losses. But they won't do that. Now, Ryan, in 2022, we averaged 400,000 jobs a month. The last 12 months, from September of 2022 to August of 2023, we averaged 250 a month. For the last 6 months, it's been 195. And the last 3 months, it's been 150. This is a trend. Okay. So in 2022, we created 4.8 million, that's almost 5 million jobs. This year, based upon this pace, it looks like we're going to be closer to about 1.8 million. I mean, this is a huge difference.
Wow.
That is a 60% drop. Now, we get crushed when the job numbers come out. Bonds get killed, reprices. Well, look at the first number. Then it gets revised, but nothing trades on it. And it gets revised again, down, down. Look at this every month. So you're getting bullshit here. It's not BLS. Maybe it should be called BS, right? And then you get the revision, but nobody trades on the revision. And it's terrible. Now, Ryan, let's look forward because there's a lot of different ways to look at the job numbers. Now, you could look at the job report that comes out. That's kind of a little bit delayed and skewed. And then you could look at the initial jobless claims numbers, but that's very delayed. That's the last thing to happen. What's the first thing to happen? When business slows down, I want to slow down my job postings. And that you have job openings and labor turnover survey. So what this does is, as you could see in 2022, we had 12 million job openings posted. Today, that's down significantly, about 28%, down to 8.8 million. Now, you might look at this and say, well, Barry, hold on. Isn't that still high compared it to pre-COVID? Pre-COVID was like 7.5 million. Yeah, but this is where you got to think. Now, how is this data aggregated? Nobody does this. The data is aggregated state by state by state. It is not a national level. States aggregate it and roll the number up. Well, what's the difference between what happened pre-COVID in the workforce and after COVID? What was the big change? Work from anywhere, work from home. So if you want to hire talent today, you don't have to put it in one state. You could put it in 6 states, 8 states, 10 states, 50 states.
Yeah, good point.
So this is grossly overstated because each state that it's posted in will roll it up into the total.
Interesting. Dang.
My dear friend Peter Bookvar had lunch with the CFO of ZipRecruiter. And he said, it's even worse than this. And Peter taught me this. He said, what they're seeing is in order to attract talent, they are looking for keyword searches. So one job is posted with several different titles to see what hits. So
any idea on what the real number is then?
The real number is probably closer to 6 million. It's much less. Yeah, we believe that this is overstated by about
really
30%. Okay, so it's dramatically overstated. And any business owner will tell you. I was just at the NAMB conference, which is probably why I said it before. I was speaking there. And a lot of business owners, when I point this out, oh my God, Barry, yeah, I do that. When I look I'm going to
Yeah.
go in states where I know that the labor's a little
Yep.
cheaper. When I do underwriters, this and that are working from home. So it clearly makes sense to people.
Yeah.
All right. Now, inflation, right? This is a big one. Inflation. So inflation is something that we know is key, but we know that shelter is the lag effect of inflation. 43.7% of core CPI and 21% of core PCE, and the Fed wants the core numbers, stripping out food and energy. What is the deal here with rents? Because it weighs so heavily. So rents are only going up 3.3%. Now, if you're looking at a report that said, oh, I see a negative 1.2%, you're right, but that's new rents. What rollover rents are about 4%. So the blended rate is what this is here. It's 3.3% blended rates. And when you get a number like this, you can see over the last 12 months how much it's come back. It was 14%. The problem is that this is where it really is, but not what the Fed looks at. The Fed looks at the average for the last 12 months. And when you look at that, the number is something like this, 7.3% on CPI. The reason it's higher on PCE is because the CPI numbers for the month of August and the PCE is for July. We will get the August read on PCE in a couple of weeks.
Catch up.
So
Yep.
that will probably come down to maybe 7.4. So they look at things a little bit differently, but it's going to be awfully close. It always is. But now, Ryan, with any kind of math skills, by the way, you could see this peak and this peak. You could see that rates moved up in real time, then rates moved up in real time. You could see rents started to go up here, and then the average goes up. There's a lag, a huge lag. Unfortunately, the Fed doesn't take that into consideration. So when we look at the difference between the two, we can do math here. We say, okay, it's 4% difference. Multiply it by the weighting of 43.7%. When you do the math, you'll see the numbers 1.7%. So this is overstating core CPI by 1.7%. So when you look in the rearview mirror, you can see that we're talking, about 4.7% of the 4.3%, pardon me, of the core PCE is where we are today. But when you apply the lag effect, it's only 2.6%, a lot closer to the Fed's 2% target. And this number will come down accordingly when we get it in 2 weeks too. So this is looking in the rearview mirror. This is looking at the side window is here. But if you look through the windshield, look at the trajectory, guys. Look at the trajectory. Now, I want to say oil is hurting us. $90 a barrel on West Texas Intermediate, WTI. That sucks, and that's hurting us. But it bleeds into the core, but it's not part of the core because it strips out food and energy, but transportation and things like that, it does bleed in. But the big point here is this, is that the Fed has a terrible habit of being way too late and looking in the rearview mirror. Look, let's say you're driving on the highway, you're going 90 miles an hour, and you notice down the road there's a brick wall approaching you. When do you apply the brakes? Way ahead of the brick wall. Way ahead, right? You don't hit the brick wall and then apply the brakes unless you're the Fed. They're the only ones who do that. Okay, they did it before. Look, every single time they do this. So back in 2021, they were the biggest cheerleaders for QE. They didn't stop QE until 2022. They kept it going another year. Why? Because they looked in the rearview mirror. Remember Janet Yellen, go big. Remember Jerome Powell, we're not even thinking about cutting rates. And all the Fed members, we need more inflation. Mary Daly, rocket scientist. I mean, these people were all off their rocker. Another one, Michelle Bowman, who now is calling for multiple hikes. She's a lawyer. These people do not have any business experience. So let's take a look at what happened. Why in 2021 were they saying we need to keep QE going and keep rates at zero? Well, because when you look at the previous 12 months from the rental index, it was only at 2.5% that was reported in CPI. Inflation's very low. But real time rents were going up at 7.5%. That's like looking at the side. This is the rearview mirror. This is the side mirror. But the trajectory is the front windshield, the side window rather. The trajectory is the front windshield. Look at where it's going. Now, if the Fed would have just toned it down and applied the brakes here, we would not have the problems we have with inflation, with higher mortgage rates, and this whole mess that we're in with the Fed hiking. We would not have the banking crisis. They've got all of this culpability on their end. Now, last point, Rye. We know that mortgage rates historically over the past 35 years have been, and that's the top line you see here, have been about 1.75% to 2% above the Fed funds rate. So that's normal. But what has happened? What has happened, Rye, is that they're now 3% above the Fed funds rate. And by the way, Ryan, don't let me forget about the short position. Okay, I want to talk about that. Why has this gone crazy? And where do we go from here? Well, I want to show you some history because we are now experiencing an event that has only happened 5 times in the past 40 years. So it is a
This is a
rare
really
occurrence.
interesting graph, guys. If you're driving, like pull over and take a look at this.
So the red line's the Fed funds rate. The blue line that you see here is the 10-year Treasury yield. Now, the 10-year Treasury yield, that's 10 years of tying up your money. The Fed funds rate, that's overnight. So it should be lower than the 10-year. If I'm going to tie up my money for 10 years, I want compensation. And that's the way it is for the vast majority of time, as you see here. But on rare instances, like right here in the 80s, the Fed got so ridiculous and crazy that they raised rates above the 10-year Treasury. What that did is put you in this gray area, which is a recession.
Yep.
And now they're applying the brakes. Now that, okay, we hit the wall. So what do we got to do? Look at how fast the Fed cut rates because they
Yeah.
went and they caused a problem. But what happened is the 10-year Treasury also came down rather precipitously. And the second time it happened was here and was the same exact thing. Carbon copy. Here, carbon copy. Here, carbon copy. And here's where we are now. But one distinction, Ryan, this is the greatest disparity, the greatest spread. In other words, the Fed has overdone it now more than they've ever done in the past. They have created an upside down, topsy-turvy situation worse than they've ever done in the past. What's the effect on mortgage rates, you might add? Okay, well, that first instance, they went from 11% to 7.5%. There's been 5 times. The second time, it went from 8.5 to 5.5. The third time's here, they went from 7 to 4.5. The fourth time's here, they went from 3.5 to 2.5. And here's where we are. Where will we go? You guys tell me. We've never had a 3% spread of mortgage rates to the 10-year Treasury. Where do we go here? Now, Ryan, let's talk about that short position.
I was gonna say, don't forget that short position. And everybody's like, Barry, we hear you, but when do they finally slam on the brakes? And the good news is, man, they dropped it. It was on average like 3% from that graph. So that'll be an interesting, like, how much does that really drop? Is it another 3%? Is it only
Look,
one?
Ryan, you know this, but every loan in the past 12 months is going to have to be refinanced because they're all above 6%. So there's an enormous refinance opportunity ahead of us. Okay. So we have planted a lot of seed in fertile ground that we will reap and harvest. The short interest, you just asked a great question. What's it going to take? And I believe it's going to take 1 or 2 crappy job numbers. We're going to have to see a bad jobs number. And that's finally going to tell members of the Fed, hey, we got to act here. We got to start cutting here. We've gone too far. The Fed is overly restrictive. So, short position. So if you want to make money in the stock market, you buy a stock and you think it's going to go up. You invest in it, you buy the stock, and you hope it goes up. That's making money by thinking a stock's going to do well. But what if you think a stock is going to go south? If you think a stock's going to do poorly and the price is going to go down, how can I make money on that? I don't want to buy it, right? Well, what can I do? I can borrow shares. I'll have to pay interest on that while they're borrowed because that's not for free. I borrow shares and then I sell shares that I borrowed. So something that I borrowed, imagine you borrowed something from somebody and you went ahead and sold it, right? So you got to give it back to them. So you're short those shares. That's where the term short comes from.
Yeah.
So you're short those shares. I've got to now buy them back at some point in time, right? The hope is that the price goes down, you buy it at a cheaper point. There's an $800 billion short position in 10-year treasuries. That is the largest short position that has ever been recorded on 10-year treasuries. So what that means is that $800 billion has to be purchased back. If we get 2 crummy job numbers, or if there's indications from the Fed that they're going to start cutting, those 10-year treasuries will be bought back with both fists, and you will likely see a very nice rally, and you'll see mortgage bonds follow suit. Now, we look at what could happen here going forward. Again, a couple of job numbers that are going to be beneficial for us would be helpful. September 20th, next Fed meeting. They're not going to do anything. A lot hinges on the November 1st meeting. The November 1st meeting will only get visibility to the October job report. The November job report will not have been released when the Fed has its decision. The meeting is October 31st, November 1st. So it's going to be very pivotal, that jobs number that comes out at the beginning of October. So that's just 2 weeks away. So brace yourself, fasten your seatbelts, and a couple of Fridays, first Friday in October, that's going to be the big one, right?
Can you go back to the graph, Barry, that showed the what happened after each time the Fed was so aggressive? Because I thought that was super encouraging, and I'm sure the realtors and LOs watching I would love to guess and figure out what's going to happen afterwards. Buddy, you mentioned earlier that you talked
First
about
time,
how
second time, third time, fourth
yeah,
time, and
I mean, and look at the correction. Look at the red line after each one. Like it wasn't a minor slow correction. It
oh
was a
no, they
very
screwed up. It's like,
yeah,
oh shit. This is like an
yes.
oh shit moment.
And you got a bigger divide than you've ever had. And some of those, you know what I mean? Like some of these are gone from 11 to 7.5, 8.5 to 5.5. So, man, is this an instance where we go 7.25 to 4.25? I know that's a bit hopium, but it certainly is
Here's
possible if
what I
history
think.
serves a purpose.
Yeah, here's what I think, where I think that the reason why that might be a little bit more difficult for us to achieve is because we do have higher oil price. Inflation is a little bit more pesky right now. Powell's a little bit more stubborn. I never want to say never, but we also have more debt, more paper that's out there. So there are some headwinds that would. But listen, 7.25 to 5.25 would be great, wouldn't it? 7.25, 5.75 would be great.
Well, I think the lenders would love a slower decline versus a rapid decline, oddly enough, because of all the EPOs that would occur in the business. So if we can just start tapering down at a healthy pace, I think we'd all be happy and answer the question of when do they finally hit the brakes and realize, okay, we've gone too hard, too fast. And I think we'd all just be excited that the fact that we're off the top of the hill moving down. But
Yes.
buddy, I got to give you credit, man. We've been friends for years. I've followed you for many years before we became friends. I mean, I don't know how many crystal ball awards you have. Last time I counted is 3 or 4. You mentioned that you got it wrong in May. Like, buddy, you had the most well thought out, articulated reason as to why you thought that. It wasn't like you just threw a dart at a board. So anybody watching, guys, there's 20 plus years of being right, day in and day out. And I was reminded, I was on the road this week. I mentioned that earlier. Top producer, guys, not a bottom producer, called me. Got a $2 million loan. Should I lock it, Ryan? And the first thing I said, because I was driving, was like, I don't know. What did Barry say? Because I hadn't watched it yet. I was traveling, and this top producer still wasn't watching. And I'm like, how are people still waking up and not knowing how to educate their clients and their top producers, educating somebody on a $2 million loan? Guys, if this is you, stop it. He's got 20 years of being right. You have to, first thing you do in this business, even if you're a realtor, is wake up and find out where the market's headed. Should I lock? Should I float? What's coming my way? We're advising people on massive amounts of debt and home purchases, and Barry does that for us. So appreciate it, man. 20 years of being right.
Pleasure.
Yeah, it's been an
I mean,
amazing
listen,
run for
no,
you. And dude, one time, come on.
well, listen, you're very, very, very kind, and I appreciate that. We own it, make mistakes. That wasn't the first mistake. There's been other mistakes. Listen, we we do the very best we can with the logic we can. Things come out, and they. This is a very, very difficult thing to do. What did Yogi Berra say? Making predictions is very difficult, especially about the future. So, by the way,
Exactly.
I just want to say it was a really great movie called about Yogi Berra. What the heck was it called? There was a Yogi Berra movie on Netflix that I'm just forgetting the name of it right now. If you pick it up,
We'll find it, throw it
oh,
on.
it ain't over. It ain't over till
Oh,
it's
okay.
over. It ain't, and it was so heartwarming. It was a really, really good movie. So
Well, man, I don't know, we went long, but I hope everybody appreciates like all of the homework that you put into that. I'm sitting there watching, like, again, there's method to the madness. Barry and the team's not just throwing a dart here. They just talked about 30 minutes about where we're heading and why. I love those last two graphs. I hadn't seen those yet, so I appreciate that. Appreciate you too, man. I'm excited for the end of the year. Believe it or not, I still love this business, and I'm so excited. You're right, and I'm glad you mentioned the run after '08. How many years? I mean, you know better than I. I think it was over 10 years, 12 years of prosperity. I believe, and Barry, you can agree or disagree, that we're going to have a similar run on the backside of this, guys. So hang on.
couldn't agree more, brother.
All right.
A common thread amongst successful people. You know what it is?
Optimism.
Bingo.
Yeah.
Bingo. I knew
You
you'd know that. I knew you'd know that. All right, guys.
Appreciate you,
Well,
bud.
and hey, one other thing I just want to say, while we're doing quotes here, it is discouraging sometimes to compare yourself to other people. Maybe your business is not where it should be, and you're watching other people. Just take action. Do the best you can do. Comparison's the thief of joy. I think that was Teddy Roosevelt.
Mm.
I just we do that when we look at social media. Sometimes look at somebody's highlight reel. So Look, stay optimistic, stay positive, do everything you can do, do all the disciplines. Don't be just busy, be effective. Um, and we'll get through this together. Thanks, Rod. I love you much, man.
Appreciate it, man. See you guys next week.